How's it going today, guys? So today we're going to be talking about an IPO, or an initial public offering. So this is going to be like everything you've ever wanted to know about an IPO. And that does rhyme, and that was intentional, just so we're clear on that. But anyways, so starting off, an IPO, like we said, is an initial public offering, which is basically the very first sale of a stock issued to the public, and the company is considered to be private before this, and only insiders are able to invest in private companies. So if you're trying to invest in a private company, you'd have to approach that company directly and try to buy equity in that company, or somehow get your hands on private stock, and it's very difficult to do. So when a stock is public, it's a lot easier to get your hands on that stock. So the general public is not able to invest in a company before an IPO, and like I said, you would have to approach a private company directly to invest in them. So it definitely makes it easier to invest in a company once the stock is public and once it's considered a public company. Now, one misconception is that all companies are public, and there's a lot of large companies that have never gone public, and there's reasons why they aren't doing this, which we'll discuss in a little bit here. But for now, here are some of the largest companies that are still private companies. We have Cargill, we have Dell, we have Mars Candy, we have Publix, US Foods, and IKEA. All of these are still private companies, believe it or not. So if you go on Google and you type in Dell stock or Publix stock or Cargill stock, you will find nothing, because you cannot buy stock in that company as a public investor. You'd have to be a private investor to invest in any of these companies here. So the reason that many companies decide to stay private is that public companies have to disclose a lot, because they have to file quarterly with the Securities and Exchange Commission. Now, private companies do not have to disclose as much financial and accounting information. So one of the advantages to staying private is you don't have to disclose so much information. Now, this is interesting. So in the past, IPOs were reserved for the best of the best, and it was difficult to get listed. So in the past, when a company was going public, it was generally one of the best companies, one of the best private companies going, and it was a company that many people invested in solely because they were going public, and people knew that companies that went public were these wonderful, great companies that were private and now have done so well that they have the honor of going public. This is not the case at all anymore, and a lot of people have this misconception that any company that goes public is just automatically a good investment, and that is so not the case. So now, due to competition between exchanges, so for example, a company could be listed on the NASDAQ exchange or the New York Stock Exchange. So basically, because of competition between exchanges, it is much easier to get listed, and lower quality companies can now go public. So never invest in a company solely based on the fact that it's going public. Don't assume just because it's going public that they're anything special. Because of competition, a lot of bad companies or crap companies are getting listed. And it's hard to tell without doing your research, and it's hard to get good information on a private company. So IPOs can be a dangerous area for investors. So here's a pro tip, and I kind of said this already. A company is not a good investment solely based on the fact that they are going public. So do not just invest in a company because they're going public. The only reason you should invest in them is if you like that company, and it should have nothing to do with the fact that they're going public. So don't just jump on the hype train. I'm sure, as you guys have seen with stocks that have gone public, they go up after the initial excitement and then they come flying down when they come back down to reality. So you don't want to be one of those investors. Only invest in that company if you think it's a good investment, not just because of the fact that they're going public. So why do companies have an IPO? If you have to disclose all this financial information, what's in it for them? Well, an IPO is good because it raises money, which allows them to grow business. It is also an exit strategy for founders and early investors. So when the founders have so many shares of that company and it's private, there's no one to really sell those shares to. But when they go public, they can sell a portion of their shares or sell a majority of their shares and then go buy that yacht or that vacation home that they want. So it's definitely an exit strategy for founders or the early investors. And it also makes mergers and acquisitions easier. So this could be acquisitions of other companies or acquisitions of talent. And what I mean by this is that the stock can now be used more easily as buying power. Now, you can offer private shares up for buying power. So basically, let's say you were trying to acquire a certain employee and you said, hey, we'll give you X number of shares of this company, of our company that is. If it's private, there's no real way to value that stock and there's no real market to sell that stock to. But once it's public, you can basically say, hey, here's exactly what the market value of these shares are, and here's who you can sell them to because they're publicly traded. So publicly traded companies have what's called liquidity, which private companies do not. And it's difficult to value or sell private shares, like we said. Now the only disadvantage, and I talked about this during my video talking about the Snapchat IPO, the only disadvantage to this is that if you basically offer someone shares as their compensation, and then all of a sudden those shares go down, it's basically a pay cut for that employee, and that can oftentimes lead talent to go find other things to do and leave your company. So sometimes equity acquisitions for talent aren't the best thing for a company. But just a couple of examples of some of the best IPOs to date as far as the amount of money they've raised. There's Alibaba, which raised $25 billion in 2014. General Motors raised $18.15 billion in 2010. Visa raised $19.7 billion in 2008. And Facebook raised $16 billion in 2012. Now there were some other ones on that list, but they were companies that were not common names, so I didn't include them. Okay, so now let's look at basically the pros and cons of an initial public offering. So here are the pros for a company. You're deciding to go public. Here's the pros for it. First of all, lower cost of capital. It also improves the prestige and company image, and that's largely based on the fact that they're now disclosing so much information. You can also acquire better talent through equity, like we discussed. There's also easier acquisition, so if you're trying to acquire a smaller company, now that you can value your shares, you can use those as leverage and buying power to acquire other companies or to acquire talent. And you also are able to raise the largest amount of money in this method. Now the cons of an IPO, as we said, the in-depth financial disclosure, and then if the market does not accept the IPO price, you may not raise enough capital. And then public info that's disclosed through the Securities and Exchange Commission may be useful to your competition. So it may be things that you don't want your competition to know, but now that it's public information, it's fair game. And then also loss of control if voting rights are issued. So if when you are going public and offering shares, if you're offering voting rights along with those shares, you will lose a portion of control of your company. And then there's also an increased risk of legal issues when you go public. Okay, so the next thing I wanted to bring up quick was simply what is called a secondary offering. So basically, as long as market demand exists, a public company can issue more shares in a secondary offering. However, at that point, the stock becomes more diluted. So if you don't get into that initial public offering and the stock is trading on the exchange and then you buy shares in the secondary market, understand that if the company does a secondary offering of shares, your shares of that company may become more diluted at that point. And it's very common for companies to do secondary offerings or offer up shares as a form of equity for some kind of acquisition or just to sell shares in order to pay off debt or something like that. So understand that your position may become more diluted in the future, and it likely will. So what determines the IPO price? Basically, the company sets the price based on, number one, the perceived demand for the stock, and number two, the estimated market cap or market capitalization, which is essentially what they feel that company is worth. So it's based on the demand and what they feel their company is worth. So now if there is high demand for a stock and the shares trade higher on the secondary market, basically it means the company left money on the table because they could have set the price for the IPO at a higher value. So if it trades a lot higher on the secondary market, so for example, check out Snapchat. I don't remember what their IPO price was, but they traded significantly higher on the secondary market. So obviously they could have had a higher IPO price. But on the other side of things, if there is low demand for the stock, investors may reject that IPO price and they may not be able to raise enough money from that initial public offering. Now, once the stock is sold, it trades on the secondary market and any proceeds go to whoever owned the shares prior to that, not the company. So basically, let's say the stock is $20 a share. Next thing you know, it goes to $30. Whoever owned those shares at $20 gets that price difference. The company gets nothing after the initial public offering. Okay, so post-IPO, after this initial public offering, what happens? Well, now the newly listed stock now trades on a public stock exchange. Usually it's the NASDAQ or New York Stock Exchange. And then there is likely very little fundamental or technical information on a new stock because there's no history with the stock. Aside from what is inside the prospectus, which is, maybe it's prospectus, however you pronounce that, I'm not familiar with that, but basically that's something that's required when they file for the initial public offering. So that's basically the only documentation as far as company information that you can get your hands on because there's no history with the stock. Okay, and then basically the company uses the funds generated from the IPO and does their business or does whatever they're doing with those shares. Now, here's something important that you guys have to realize. For insider investors, there's what's called a lockup period. So basically, company insiders sign an agreement not to sell shares for a specified period of time, and that can range from 3 to 24 months. Now, when that lockup period expires, that lockup expiration can put immense bearish pressure on a stock. So you want to make sure you're aware if insider investors are locked into those shares for a certain period of time, because if they all sell their shares at once because they are not very hopeful about the stock, it can send the stock into a nasty downtrend and you can lose a lot of money. So make sure if you are investing in an IPO, you determine whether or not investors on the inside are in a lockup period on those shares. Okay, so here's the strategy that people have in mind with an IPO, and it's called flipping an IPO. So this is basically when you resell a hot IPO stock in the first few days to make a profit off of the excitement of that stock going public. Now, this strategy is frowned upon because the company is generally looking for long-term investors, and largely that's the case too when they're offering voting rights. They want people who have an actual interest and an attachment to the company itself. They don't want random people just looking to make money who now have voting rights for company decisions. However, if you're Snapchat and you're not offering voting rights, you probably don't give a shit who holds those shares because you just want the money. But I'm not going to get into that right now. Anyways, your broker may blacklist you from future IPOs, assuming you were lucky enough to get in. And I'm going to explain that more below here, what I mean by lucky enough to get in, because a lot of people don't realize this, but when you buy shares of a stock after an IPO, and they're trading higher than the IPO price, you're now buying shares from somebody, whether it be an institutional investor or maybe a company founder or something like that. You're now buying shares that they're selling because you couldn't get in on that initial public offering price. So now they're trading on the secondary market at a price that's now adjusted based on the market demand. So the other thing to mention about flipping is that because of flipping, it is not a good idea to buy shares of an IPO on the secondary market if you didn't get in on the initial offering due to immense amounts of volatility. So let's say you see a stock that's having an IPO and you think you want to be a long-term investor, definitely give that stock probably a couple weeks to calm down and find a healthy price base before you decide to invest in that stock, because otherwise you may be way overpaying for a stock just based on that excitement, and it may go into a nasty downtrend due to the volatility of people flipping the IPO. So what I mean by lucky enough to get in is that unless you are an institutional investor or your investment bank is part of the underwriting process of an IPO and receiving allocation, you can't get in on the initial offering. What you will be doing is buying shares on the secondary market after market demand sets the price. So it's very difficult, if not impossible, for a small investor to get in on the initial public offering because it's reserved for institutional investors. And the institutional investors, basically what they're going to do is flip the IPO and sell it on the secondary market. It's one of the biggest double standards there is. They don't want individual investors doing it, the small guys doing it, but institutional investors, not a problem. Go right ahead. So it's definitely a double standard. Nothing we can really do about it. But if you're investing in a stock post-IPO, you're most likely buying it, or I guarantee you're buying it off of the secondary market after demand has set the price for that stock. So getting in on a hot IPO is almost impossible for small investors. Anyways, guys, that is pretty much everything you ever wanted to know about an IPO. I hope you guys enjoyed this video. If you did, please drop a like below and then drop a comment as well if you have any feedback on this video or ideas for future videos I can do on this channel. And if you guys are new to the channel, please consider subscribing to be notified of any future uploads. And as always, I thank you guys for watching this video.